Next one is HSBC, and this HSBC, of course, is a well-known bank, and even though it has presence in China, it is different exposure because it's not just China. It has other parts of Asia. More than 50% of the revenue comes from Asia. Okay, but it's not just mainland China. Property crisis also not so exposed, right? 2% of this total loan, this is a developer side. This is not the personal loan. Personal loan, I think, add together got 20 over percent. Okay, exposure to the China properties, right? But the developer loan is the concern, which is even much lower due to the lower exposure to China. And Europe, they have a big presence as well, 30% of the total revenue. Okay, then the rest not important. North America a bit, Middle East, Africa a bit, Latin America 5%, right? But you can see that it's rather global, right? Very few banks are that global. You look at Singapore banks, majority of the business come from Singapore, obviously, right? Even for US banks, majority of business come from US. You look at the mainland China bank, majority of their business come from China, right? HSBC is a bit different. They have a broader global exposure, right? Even though more than half come from Asia, but a good 30% come from Europe, and they even have businesses in other parts of the world as well, right? So you can say that it gives you a different exposure, right? And if we take a look at the Europe side, okay, Europe banks also done well last year. As I said just now at the start, global banks did well. Interest rate were going up, interest margins were going up for the banks. And this blue line, okay, this is reported by London Stock Exchange, right, for November 2023 to October 2024. Okay, so the European banks that you can see as a whole, right, has went up more than 30%. Okay, while HSBC was up for that period, but it was up only about 12-13%. Right, so that was underperformance. Okay, there was underperformance, and this is where I think that's why the management, they have a new boss. Okay, so now they are undergoing some restructuring. Okay, so to boost their performance, right? So it is likely investors didn't like their performance as much as compared to other banks. Okay, but actually it's not that bad, right? But anyway, they are going a restructuring, and these are what they're going to do, right? So they are going to restructure based on the reporting lines, right? The business segments will change. And one of the things is that they're going to consolidate the wealth banking into one segment by itself, and they're going to eliminate redundancy. That means even some of the senior roles, right, are going to get cut, right? And they expect about an annual savings of $300 million, right? And they're going to focus more on wealth management. Okay, this is also a growth area, right? Especially in Asia, okay, because of the rising affluence as well, right? Which they have a good presence there, here. Okay, and even in Singapore, they bought over the AXA business, the insurance side, right? So they are expanding that kind of area. Okay, so it's a good thing usually when you see a company undergoing restructuring, right? And there's some efficiency, some cost cutting, okay, because this will form tangible expenses reduction, and that should boost the net profits as well. Okay, and you need because over time certain organization will get too big, every bosses play nice, then actually there are some roles not contributing as much as what previously were, right? So then you do need to trim some of these fats and rejuvenate the business a little bit. Okay, so this is something that's positive. So that means that once the restructuring is done, the performance may improve, right? So there can be some value unlocking events going on for HSBC. And for the dividend yield, as of 7 Jan is 6.34%, right? So again, not that bad, okay? And comparable, right, to Bank of China. And you can see overall, there's also rising dividend per share, right? Of course, there's a dip during COVID, but same thing, they managed to grow. 2024, I think they haven't announced the final one. So that's why it's supposed to be higher, right? This is only half a year. This is only interim. Okay, got high chance that it will be again a higher dividend per share year. So you can see actually the performance is not that bad. right? Growth is still there. And let's look at the price ratio, right? Price to book is 0.92 times. 5-year is 0.7, so it looks a bit expensive. But you look at other metrics, PE at 7.9, average 5-year was 9.7. So from a PE angle, it's actually cheaper, right? And from a dividend angle, it's also cheaper. Now it's paying about 6.3% yield, but the 5-year average is about 4.5, right? So all along, HSBC don't give you 6%. Okay, so maybe give you less than 5, right? So there is potential, some undervaluation over here. So relatively, HSBC actually looks cheaper, compared even to the China Bank, the BOC that we saw just now. Okay. There's also a HSBC SDR. You can buy HSBC via SGX, and the lot size again is 100. And this case, the price difference or the lot size difference is a lot larger, right? If you buy the Hong Kong version, it's 400 shares per lot. Minimum investment is be about 5K. Okay, harder to size position compared to just now what we saw in BOC, right? So for the Singapore one, it's 265 per lot. Okay, the ticker I forgot to mention just now. So the ticker for the SDR in Singapore is HSHD for the HSBC SDR, and for BOC is HBDN. And these are the ticker if you're interested. Okay, let me answer some questions before I finish up for the last part. All right. We consider shareholders if we buy the SDR. You are not a shareholder if you buy the SDR, but you are given corporate action rights, okay? Which means that as good as you are a shareholder, but you're not. Okay? You're a depository receipt investor. So when the company give dividend, you will receive the same amount as with a shareholder. If there's major corporate actions like rights issue, splits, all these kind of corporate action, you also get to participate. You cannot attend the AGM, right? You're not a shareholder, okay? But if you decided you want to be a shareholder, you can convert the SDR into the underlying shares by paying a conversion fee. Then you become a true blue shareholder. Okay, so even though you're not exactly a shareholder, you do get the rights, majority of the rights as a shareholder, right? Not all, but majority of the benefits you will get. Yeah. ICBC is listed in SSE and HKEX. What are the reasons for buying an SSE? As I mentioned just now, right? One is forex consideration. The other one is that usually the A share trades at a higher price, your dividend yield is lower. Right, ICBC, you will buy in A share, your dividend yield is going to be lower than in Hong Kong, sometimes by 2% difference. Right, so for example, it's like if SSE one is trading at 5% dividend yield, the Hong Kong one is trading at 7% dividend yield. Okay, both draw a 10% withholding tax. All right. What are your views about investing in state-owned banks versus private banks in China? Are the 4 banks mentioned state-owned? Yes, the 4 banks are state-owned. Okay. I would say that majority of the bigger ones are state-owned, so you can't run away. And when people talk about, I would say that in China, state-owned may not be that bad. In the past, it's very bad, okay, because state-owned companies used to be run very badly. But now I would say that state-owned may be better because you are investing alongside the government. Because in China, we all know that it's a very top-down economy, correct? Or the government has a lot of say. In US, it's a bit different. It's bottom-up entrepreneurship. Then private investment is probably better. But in China, maybe, flip it around, go with state-owned relatively might be safer, right? That's my view now, right? SDR to Hong Kong stock ratio is 1:1. It depends on the SDR. Some are 1:1, some are like 5:1. The details will be reflected in the respective SDR.